Okay, guys, today we have a very interesting guest, and this was actually kind of interesting to Steve and I because of the approachability around what you do and how you invest. You can invest in real estate. So this is Lawrence Raponi from Equiton, and they are a private real estate equity firm. Like I said, this is really interesting to us because of the options around how you guys can invest in real estate. Especially with some of the RRSP stuff that we've heard you do.
That's right.
Right. So again, Lawrence is the associate vice president at Equiton, and I'll let you give a bit of an intro of who you are and your experience.
Before I say anything, Steve, Antony, pleasure to be on the show.
Thank you.
Really appreciate you guys having me. So what do we do at Equiton? That's the first question everyone has when I start all my conversations.
Right.
The simple answer is, we help investors build generational wealth with real estate investments that both generate passive cash flow and have exemplary growth. But the more complicated answer is how we run our firm and actually how we drive that value. And at Equiton, we really do two things. They're two sides of the same coin. On the one side, we're real estate investors, right? Mm-hmm. We aggregate capital together. We redeploy that capital into different types of real estate assets. But that's actually the smallest part of what we do. That's my job. Okay. The main engine of what we do at Equiton, the value we provide our investors, is that we're asset managers, right? So once we acquire these properties, we preside over them throughout that investment's life cycle. And that's really the value that we bring. We have tons of experience doing this, and we have a track record of success in delivering very stable and very consistent returns.
So Lawrence, a big point here is you are, if anybody wanted to invest in real estate, this is definitely an option, right?
Absolutely.
The traditional way of buying real estate is either expensive, extremely expensive, or if not expensive, it's some people don't even qualify.
Yep.
You're providing an opportunity of anybody pretty much being able to invest for as little as...
Yep, depending on which investment we're talking about, anywhere as low as $5,000, anywhere as high as the minimum is $25,000. So we like to think we have something for everyone, depending on the sophistication of the investor, the strategy that we're looking to employ, the comfort level with risk, and all of these types of components are considered before I would advise any type of client.
So there's really, I want to get this point across, there's really no excuse.
No, there's no excuse whatsoever.
Right.
And we all know how popular real estate's been as an asset class over the last 15 years. Mm-hmm. But there are some serious hurdles to getting into that asset class, right? And I have many conversations with investors, both current direct real estate investors and people that are brand new to the space. And time again, the same three things come up always. It's, I want to be in real estate. Right. I know that. It's something I can physically see and touch. I understand it. I live in a home or whatever the case may be. But I'm having trouble coming up with that sizable down payment, right? If you're buying a property in the GTA, $250K easily for a down payment. Or maybe you have that capital, but you're not comfortable deploying all of those assets, took you years to save that up, all onto one property, right? Where it can all go amazing or it can all go terribly wrong, honestly. Now, if you satisfy that requirement, the next step is getting financing. And again, if you're a primary homeowner, you might be fully leveraged. Acquiring financing for a second property purchase, very difficult. The last thing, and by far the most pervasive, is the time commitment. Everyone wants to own real estate. Everyone wants to make money through passive income. No one wants to be a landlord, right? Being a landlord is a part-time job on a good day. That's the phrase I like to use. Right. And I say that as a landlord. I manage 11 doors. I'm a younger guy. I'm 35 years old. I'd like to think I'm motivated and have time on my hands. And I got to be honest, I'm fed up with a lot of my properties half the time. And if you guys are landlords, you'll know as well.
Lawrence, I just want to touch on what you just said, passive income. So if you can explain that to the audience, what we're talking about.
Yeah, for sure. Passive income is another type of like buzz phrase that a lot of financial people use. We don't really look at it through that same lens at Equiton. Passive income for us is a way to, as an investor, receive routine cash flows that are stable, that you can depend on. They're highly consistent. Based on an investment that is generating that revenue. Now, depending on our strategies, that's coming mostly from rental income, but it could also be other types of investments like private lending and other real estate investments as well. But that's one of the main drivers of value in our funds. It's that we can provide that very stable, very consistent passive cash flow.
Can you explain the types or the styles of real estate investment that you guys do? Because I know there's funds and then there's
Exactly. So instead of jumping, I guess we'll touch on the styles first. So We have two fundamentally different styles of investments at Equiton, right? They vary by return structure, passive cash flow, risk, and all of that stuff. On the one side, we have our funds, right? And the funds are our bread and butter. It's what we founded our company on. Now, a few characteristics, of the funds is that they provide passive cash flow. Both of our funds pay a 6% annual distribution paid monthly. Okay. They are also diversified investments, right? So a single investment in either fund is going to give you diversified or fractional exposure to an entire portfolio of properties, and they're very liquid. You could sell them pretty much whenever you want, although there are some restrictions that go along with that, but you can sell them largely whenever you want. Now, on the other side of the spectrum, we have our development investments. These are generally much longer term. They are not diversified whatsoever, so it's a direct investment in a specific project. That's right, and that project will have unique characteristics to it. It'll be in a certain area. We're building a certain asset class. That project may be 5 years, and maybe 7 years in length. And the other thing to note is that they're fully illiquid, right? You can't decide 4 years into a 7-year project that you want your capital back.
So the exit strategy is different.
Yes. Now, the developments are much more constrictive, right? Little less, no passive cash flow, no being able to pull out. However, you're rewarded for that level of constriction, right? Very, very high returns in these developments.
So this is really the first people in on it. Like when we talk about pre-construction, talk about being the first people in. This is really the first people in now.
So when you buy a pre-construction condo, it's this misconception that you're getting in at the ground floor, you're getting a very good deal, and you're going to make out like a bandit on this.
Right.
You have to understand that as a pre-construction condo purchaser, you're buying it from us. We are the ones that are using that pre-construction sale as an exit strategy. So our investors profit from that pre-construction condo sale. We're truly the first ones in.
So there's a question on that, on the development side, which is something that you offer. Strictly development side, there's a certain period that you can buy, correct?
That's right. So another thing to understand with these developments is on the fund side, they're what we call an open-ended fund. And you can think of it like a stock. They're always open. As we take in more capital, we simply go out and acquire more buildings, right? On the development side, we only need a certain amount of capital, right? Let's say we're building a 20-story condo. We're raising $35 million for that project in equity capital. Once that $35 million is fully allocated, that's it. No money goes in or out. We close down the capital raise process. We begin with the development of the project.
I have a question on that.
Yeah.
I know there's a limited time period. I don't know exactly what that is. I'm assuming it's much shorter than 5 years.
Yes, the capital raise portion can take anywhere from, I would say, 2 months to upwards of 4 months, depending on the size of the project and the level of interest.
Gotcha. Yeah. I was thinking about, what if I was the first guy to invest? How long do I have to wait before, okay, I've got enough funds now, it's closed?
That's such a common question. You want to know how much capital has already been raised for a project. Generally, people don't want to be necessarily the first person in the door. And to those people, I say, look, you have to understand that with the development, there's lots of things we can get started on before we raise the full amount of money, right? Like in order to submit an application with the municipality, we don't need $38 million to do that, right? And so there's elements of the development that we can get started on early, right? So it's not like you're punished for being an early adopter.
That's true, but at the same time, you are giving a timeline, which helps.
Yeah, for sure.
It doesn't feel open-ended, right?
For sure, and we've had a few investors, and my previous experiences, that'll be like, oh, I'll wait until you're closer to being fully allocated, and then 3 weeks goes by, and I get a phone call, and they're like, where are you? And I said, we closed the project last week.
Right.
Right, and that's the most stark lesson that an investor can realize. And I'll say, next time, just if you're interested in investing, give me a call, and we'll talk about it.
Okay, so Equiton is a private firm, a private equity firm.
Yes, and it's important to distinguish between public investments and being a private equity firm.
I want to touch on, so you offer funds, two types of funds, and a development direct investment. Right. So and the two types of funds you already said, one is through passive income.
Yep.
And appreciation as well, right?
That's right.
That's one fund.
Cash flow too, right?
Yeah,
cash flow.
Yeah,
so that's
passive income. So both of our funds, like you said, we operate two, but both funds pay that very healthy 6% annual cash distribution. So if passive income is your strategy as an investor, you're going to be at home in either fund, right? Gotcha. Now, they differ on the growth side. The residential real estate fund is going to be a little more conservative, but much more stable and much more consistent. Our second fund, the Income and Development Fund, still has that income component, but it also has exposure to some of our development projects, right? So you're going to get that high growth coming off of these developments, but also diversified away risk-wise with some very stable income-producing real estate assets as well. So it's meant to be the jack of all trades fund, sort of a one-stop shop.
And that return is what?
For the Income and Development Fund, we're targeting returns between 12 and 16%.
And the other one, which is a little less
risky.
risky.
The Residential
also?
Income Fund, the more conservative one, we're targeting returns between 8 to 12%.
So when you say 8 to 12%, you are referring to the cash return and plus the appreciation.
Exactly. We're talking about the culmination of factors. So we can break that down a little bit. And the way I like to speak about both of our funds, for that matter, is that they're really meant to mimic physical real estate ownership. Right? Like the idea here is that if you're an investor and you have 10, 20, 50, 100K to invest in real estate, but you're coming up against some of those obstacles that we had discussed earlier, don't want to be a landlord, can't find financing,
down payment,
aren't comfortable with the down payment, you can make an investment in either of our funds and it will mimic exactly what you would have gotten if you went out and bought a property.
So why would they choose, because if I'm watching, why would they choose this versus stock market or an index fund in the stock market?
Yes, that's usually the first thing I address with clients, because people say, they're like, well, what's your ticker symbol? Are you publicly traded? And I say, absolutely not.
Right.
And they say, are you trying to be? And I say,
absolutely
couldn't
not.
be further from the truth. We're very, very happy to be private. We're proud to be private.
Right.
And as investors, there are many unique advantages that private investment firms allow that public investment firms just don't match. They can't. And it has to do with the mechanics of how these things are priced. So when I'm talking about a public investment, like a stock, a mutual fund, an ETF, we all have these in our RRSP accounts and our TFSAs. A fundamental characteristic of these investments is that their value is determined by the market itself, right? You have all these traders that are participating in these marketplaces, and they're setting the price of a stock based on supply and demand, right? The problem is, and we're seeing it this year, 2022 is a perfect example, there's a ton of volatility. Right? These markets are going up and down like a yo-yo. Traders are trading on emotions like greed and fear. They're using short-term speculative strategies.
So you eliminate that kind of stuff.
We have eliminated that volatility, right? Because we are not traded on these public exchanges. Now, what you're left with as an investor is something that is much more stable and much more consistent, because the value of an Equiton investment isn't determined by this irrational market, we'll say, of buyers and sellers, right? It really doesn't factor into how we price our investments. Now, a natural question after that is, well, then how do you price your investments, right? They're not determined by the market. What sets the price of an Equiton fund? And it is the appraisals that we receive on the buildings that we own in our portfolio.
So it's real.
That is what moves the needle. It is real. Again, it's set to mimic actual real estate ownership.
And and sorry, just to reiterate again, your two funds, one is your income and appreciation plus development, and the minimum for that would be?
The minimum for that one's actually the lowest across our investment spectrum. It's 5K.
Right, and then the other one was 10K,
And the other one is 10K. The Residential Income Fund is 10K.
And I don't remember if you said it, but I did watch one of your interviews. So, and then what about the development side? Strictly development, which we can talk more about.
Yeah, for sure. So the developments are, I would say, first of all, geared to a little bit more of a sophisticated investor, and that's indicative of the fact that we do have the highest minimum on this one. It's 25K. And I say they're more sophisticated because there's a lot of complexity involved with developments. There's a lot of nuance to projects, a lot of things that can make them be complete home runs, absolute successes, and some that can make them mediocre as well. And it's difficult to fully understand how developments operate and how they move. They're really like their own living, breathing thing. That's really how they are. Something will happen over here at day one in a project, and it'll influence something at year 5. Right? That's really how they operate. But they do offer the most attractive returns in the business.
Which is
we're targeting annual returns of 20%.
Of 20%.
Yeah. So it is the type of investment where you can double your money every 5 years.
Every 5 years.
So it's very, very strong performing.
But again, you got to put a little more down.
And
you got to be able to say goodbye to it.
There's no take
7 years,
right?
maybe,
There's no
5.
take backs.
Exactly. And for that reason, they actually complement RRSP accounts very, very nicely, right? Because you have an RRSP account, you want to deploy that into real estate.
That's one of the biggest things we liked, was because we obviously want to invest in real estate, if anything, and a lot of people have RSPs.
That's right.
So how do you take that and put it into this kind of investment?
So it's done very, very similarly to any other type of investment, right? You're going to have a registered account, could be a TFSA, could be an RRSP, could be a LIRA, RESPs.
Yes.
All of these are tax exempt vehicles.
This is awesome.
And we'll just take that capital, make sure it's in a cash position, we can redeploy that into an Equiton investment. So it works the exact same way. Still sits in that account. You can log into your online banking platform. You can see the value of your investment, but you're purchasing an Equiton investment. Now, the mechanics of how that works, I think, is a little more complicated. I don't think we need to go too much in depth. But for those viewers that are interested, if they want to reach out, I'm happy to walk them through that process.
That flexibility alone, like we were talking about before, I don't have a down payment, for the traditional buying and selling of real estate.
Or you have it, but it's stuck in a lira because you spent 30 years working at some employer. Exactly. Right? And you can't pull that out and buy a townhome.
From 12 years, I have it.
Yeah,
right.
See? So, and it's very, very common among my investors.
Yeah.
So again, I'm going to reinforce the fact there is literally no excuse. Like for somebody to say, I wish I could invest in real estate, but I just don't have the fund. Like all the excuses we talked about. Well, I don't like being a landlord. I don't have the funds. I have the funds, but I don't qualify. I have the funds, but it's inside my RSP. All these things are taken care of. Look, you want to be in the market.
Eliminate many of the biggest hurdles to real estate ownership and real estate investing. And I find my job is mostly to act like an educator. It's just to have conversations like this, right? And let people know that these options do exist out there. There are credible companies with track records of success that have been doing this for years. Equiton's certainly one of them, right?
Do you guys, do you guys pay, so on the development side, if I was investing in that, I'd kind of want to know, okay, so who's the developer, or what do they know that information? Do you guys work with specific developers?
That's a very good question.
On an ongoing basis?
First of all, we're not the only type of investment firm that does this. You can invest in developments through other sources. But at Equiton, we're unique because typically the way this industry works is there is a capital raise partner and a developer partner, right? The capital partner comes up with the money, that $38 million for a condo construction, that equity portion. They'll partner with a big developer to construct the asset, right? Each one brings a level of expertise to the table, and they both get paid, of course. Equiton's unique because the main skill set of our chief executive and our chief financial officer, they're both developers by trade, right? So this is the sandbox that they love to play in. This is where all their expertise is. It's where all their network lies. So at Equiton, we are both the capital partner and the developer partner. We do everything at Equiton completely in-house.
So you actually own the development like you guys do it yourself?
We do everything ourselves.
Oh,
right?
okay.
And for that matter, we also do our own property management. So the phrase I like to use is we are a fully integrated real estate investment firm. We don't outsource any aspect
you don't outsource
of
to a
the property
for
or the
development,
investment.
as an example.
No. Everything's done completely internally.
Okay.
Now, this is important because it's got two main advantages, we'll say. The first one, increased control. This is the biggest advantage. We don't want the control of our development and our investors' capital to go to some other firm that may have 6 or 7 other developments on the go. Maybe this project isn't the most important project on their list. Maybe another project is. And maybe they allocate their human and building capital accordingly. Right? The second reason is it's cheaper. It's much less expensive to effectively eliminate a cook from the kitchen, right? We've removed the developer partner, and by doing so, the profits flow more efficiently, we'll say, to our investors.
The synergy is
right?
a lot.
Now, of course, we're taking some profits for us on both sides, but because we're on both sides, those profits are less.
I wanted to just touch on something to differentiate a public company or buying REITs versus investing in you. I would think buying into your firm is a lot more flexible in the sense that I could be talking to you all the time, for instance.
Yes, you're going to get a level of attention with a firm like Equiton that you're not going to get at any bank, at any investment firm, anywhere else. Yeah, and the reason, it's just our approach to how we manage our business. I exercise this idea of extreme accountability to my investors. They have my personal work cell phone. It's saved in their phone. They can call me on a Sunday morning at 9 a.m. They're not going to be put on hold. They're not going to be talking to some offshore customer service rep that has no idea what their personal situation is, right? They're getting me, right? I gave them their investment. I know their situation, and I can advise them accordingly. And people appreciate that, right?
Absolutely.
Now, you kind of hinted at something earlier, and that was, you mentioned publicly traded REITs, right? Because our two funds that we offer are actually pretty similar to publicly traded REITs. And a very, very common question I get is, what's stopping me from just going to my online trading account and with a few clicks of the mouse, I can purchase these online REITs? Why would I go through the trouble of speaking to you, doing an investment at Equiton? And the reason is, these publicly traded REITs, they have a ton of market risk associated with them, right? Because they're going to fluctuate with the rest of the stock market. The fact that you are investing in real estate has less of an importance than the fact that it's public.
And last year there was huge volatility in the market.
Think of the onset of COVID, right? March 2020, when the entire market sold off 38%. Did the REITs suffer less than 38% along with the rest of the market because, you're investing in a real estate physical asset? Right. Absolutely not. It dropped more.
How did it affect you guys in that time?
It doesn't affect us.
At all? Like no one's pulling investments out?
No one pulled investments out. To say, however, we were completely unaffected isn't true because, of course, a national pandemic like that, international pandemic impacts people, right? People's jobs are lost or they're put on hold. People are reducing expenditures.
Yeah, they're not thinking.
And so for us, we did see vacancy rates start to increase slightly, but we were able to get out ahead of it, have these conversations with our tenants, negotiate payment structures, and the returns of our investments were not affected. More importantly, the amount of cash flows that these funds distribute were not affected. We were able to maintain them all.
Talking about being affected, I know you had your returns, you mentioned some returns, 8 to 12% on the, now inflation is through the roof. And I understand that inflation actually helps this fund.
It really does, particularly the residential fund. So our more stable, more secure residential fund. And I'll explain why. We all know inflation is nothing but a measurement of the cost of living, right? You go to the grocery store, you buy some fruits and some bacon, and you notice the price is higher. Living quarters, right? Paying rent is also baked into that CPI, right? The cost of living.
Yep.
Now, as long as or insofar as inflation is running hot, well, all that means is that the cost of living is running hot, and that includes rent. And that should make intuitive sense to many of your viewers because we know that although real estate valuations have softened slightly this year, the rental market has never been hotter in the GTA, right? It is it's a good time to be a landlord, right? If you already own that property. And as the residential fund, being a residential buy and hold strategy, we're the main benefactors from that. And that's actually what we're seeing. We had a record year this year, right? So we're targeting 8 to 12. I think we did 15.8% this year.
Now, on the same with that, is your development a little more volatile now with inflation?
The answer is always, with these types of questions, it depends. And it depends because there's an element to developments that you don't really consider with other investments because they are shorter in nature and that they only exist over a certain period of time, right? I'm doing a development today, which means I'm influenced by the macroeconomic climate of today. So the way our development team approaches this is what you don't want to see is you don't want to see the macroeconomic environment shift underneath you mid-project. Mm-hmm. Because at the outset of a project, like for instance, we're launching one currently, we're raising capital for it, we have made a base set of assumptions pertaining to macroeconomic inputs, right? Interest rates, inflation, and we projected that out over the life of the project. In this case, it's 5.5 years. Now, should something happen at year 4 or year 3 that changes our original assumptions,
significantly,
well, that's going to adversely affect the profitability of the project. So if you had started a project in 2019, right, interest rates were at 0, inflation was stubbornly low. And so as a prudent developer, those were the assumptions you used, projected them forward. Mm-hmm. Then you hit 2020, international pandemic, everything flips on its head. None of those realities are baked into your early assumptions. Those projects will be negatively affected.
Right.
And that's why timing is important. And I bring this up because, for instance, this project we're talking about currently, we're launching it as of June, July this year.
Which is very
We
current.
already know where inflation is.
Right.
We're already seeing a softening in real estate valuations. And these assumptions have been baked into our financial models. Right?
And we're addressing them too.
We're going to be surprising to the upside.
Right. That's
because inflation isn't going to be persistent for the next 5 years, maybe the next year. Right? Interest rates aren't going to be at 7% for the next 5 years, maybe for the next 2 years. Right?
Absolutely.
So insofar as the macroeconomic environment shifts in our favor, well, it actually works the other way. This can become a more profitable investment.
Right.
Right?
Yeah.
But again, this doesn't apply to every single project. Timing does matter.
Right.
It for sure matters.
And that profit gets passed on to not just you guys, but also the investors. Both.
Absolutely.
Right.
So we are the general partner of these projects, and this would apply to the funds as well. We're the GP. We preside over the project. We are responsible for its operations and its management. That applies to the funds too. Our investors are the LP, the limited partner, which means they don't get a say in the overall operations of our funds or the developments, but they share in the profitability. Right? So as we do better, they do better, and vice versa. This is not a debt situation where they're giving us a loan and we're paying them an interest rate. That's not how this works.
So if I were to come to you, you're going to point to a fund or an investment based on my current situation, correct? You're not going
That's
to
right.
say this is, definitely go to this development side. Definitely do you choose this fund
No,
or
no,
that
no,
fund.
no.
You're
That's
looking at my
usually-
risk assessment. You're looking at
For
my
sure.
age, at our age.
Oh yeah, I take a very holistic approach to my clients. And to be honest, the first conversations I have with clients start off exactly like this one did. Who is Equiton? What is a private equity investment? Why is it different from something you may have currently? Right? What value can this pose to you as an investor? And then usually after that introduction, I go right into asking questions. I want the client to talk. I want to know who they are, how old they are they married? Do they have children? What level of experience do they have with real estate investing? Is this their first one? Do they have RRSPs and TFSAs? Do they even know what those are? Right? I have some clients that are extremely savvy. They have millions with us in trust funds. They have 3 or 4 properties they run. I have other investors that will ask me, what's an RRSP? Right. So my client base really spans the spectrum, but I have to have all of these conversations, right? I need to be able to speak with a very high degree of sophistication with somebody and then turn around and explain what a TFSA is to someone else, right? But that discovery process is what informs the way I recommend or the way I advise. Right?
So and just to be clear too, the non-development funds, both those other 2 funds, those are more liquid, you said, right?
Yes.
So if someone wants to invest in real estate for now, until they can make their own personal investment, grow their equity a bit, they can invest in one of those 2 funds earning 8 to 12%, let's just say.
That's right.
And then if they want, remove it and buy something themselves down the road.
That's right. And
Without
it actually
having
serves,
to have an issue.
Exactly. So we do have minimum holding periods on our investments on the 2 funds. And it's simply a term that we ask from our investors in order for us to make efficient use of their capital, right? You have to understand if someone approaches us and gives us $2 million. Well, that's great. But if you pull it out in 4 months, I can't do anything with it, right? I can't go and buy an apartment building with it, right? And insofar as you do pull that out in 3 or 4 months, well, it actually creates a risk to the fund because what if I don't have your money? What if I went out and bought a property with it?
Right.
Now I need to find $2 million to give you, right?
So what are those minimums?
So the minimum is 3 years. We're asking for 3 years from our investors. Now, it's what we call a soft holding period, right? Hard holding period is something like the developments where the project is 6 years. You can't pull out before 6 years. You ask me, my answer is no. Soft holding periods, you can actually redeem whenever you want. You can make an investment today and then in 3 weeks, call me and say, Lawrence, I changed my mind. I want my money back. Not a problem. We will honor it. The way we enforce the 3-year commitment is by charging early redemption fees to those
Which makes
investors.
sense. So you can't,
Right?
it makes sense. You can't operate otherwise.
Well, generally speaking, our investors understand that this is a long-term investment, right? We
Which
are
real estate
going
is
out and
anyways,
buying
right?
real estate, right?
Right.
And at the beginning, as part of my discovery, I'm always talking about time horizon. It's right up there with risk and what are you looking for in an investment? What's your strategy? What's your time horizon, right? Are you comfortable with a 3-year investment? And if you're not, this isn't for you because we don't want to charge those fees.
Right.
We only use them to incentivize a 3-year commitment. What we want is time. We don't want the fees.
Right.
I want to touch on the minimums again, 5,000, 10,000, 25,000, and the flexibility of where you can pull that from, that money. I wanted to add one more flexibility. Can you partner up with somebody? Can I partner up with a friend?
Certainly. So
Okay.
we do all types of investments at Equiton. So, and that includes corporate investments and joint investments, right? So if you, husband and wife, want to get together and do an investment, we can accommodate that. If 2 business partners want to, we can also accommodate that, including investment
no
in
excuse
corporations.
now.
So there's really no,
there's really no excuse.
That 25,000 now just became 12,500, or I'm assuming if you
Yep.
divide it by 3,
Yep.
even?
If it's done through a corporation, that's exactly how it works. Now, these investments are meant to be flexible, right? That's one of their main value propositions. They're flexible, right? Even that cash distribution on our 2 funds, if you come from a dual income household, maybe you and your husband or you and your wife are working, you don't need that capital. You certainly love that these are profitable investments. That's why you made them, but you don't need access to that monthly cash flow. And for those investors, you can put it back in the fund. You can automatically repurchase more and more units month after month, which is now a huge tool to allow that generational wealth to start to build and snowball because your investments just starts to build on itself and accumulate over time.
So that cash flow every month, you can just say, look, that cash flow, just please reinvest
it. Can be reinvested. And this is a feature that we can turn off and on as my client situations dictate, right? Let's say you're 55 years old now, you're doing a nice lump sum investment, you're going to reinvest that cash flow, you're still working. Now you're 59, you're kind of thinking about early retirement. So you call me up, you say, Lawrence, I don't want to redeem my investment. I'm very happy with the returns. I'm very happy with the service you're giving me. I do want to start taking in that cash flow. So please turn off the distribution reinvestment. I want to start receiving.
What's the portion of it? Sorry.
No,
What's the portion of it that would be the cash flow portion of the
So
of the
on
return?
both funds, we have 2 funds targeting 8 to 12 on the residential, 12 to 16 on the income and development. Both of those funds pay annual cash distributions of 6%.
Okay.
Distributed monthly.
And it's distributed on a monthly basis.
Just so if I say, look, I want it reinvested, I want to buy more units every month. Don't give me the cash. Do I have to pay? Am I deferring my taxes?
There's no fees of any kind.
No fees. That's perfect. But I'm talking. That cash flow? If I'm saying, look, just keep buying more units with it, do I still got to claim that cash?
Oh, tax. You're asking about tax.
Yeah, sorry.
So,
I'm off. If I'm going way off, forget
No.
that.
I hear you. It depends on the funds. So mechanically, how they work is even if you choose to reinvest, we are paying it back to you, and you're automatically reinvesting. But the profits are paid to you. So typically, there is a taxable event that's initiated off that. Now, this applies particularly to the residential fund. One of the fantastic selling points of the res fund is how efficiently it's taxed. It is incredibly efficiently taxed. You're never going to find another physical real estate investment that is taxed this way. It's called 100% return of capital. So I'm going to walk you through what that means because I'm sure many of your viewers will have no idea what this even means. Return of capital is a mechanism whereby the taxable event isn't occurred in the same year the investment is made, right? Okay. So let's say you go out and buy a condo, you rent out that condo for 12 months of a year. At the end of that year, there's a tax bill owing for the 12 rental checks that you received, right? And it's owed in the same year the income's earned, right? You pay tax for the 2022 tax year. With the residential fund, you're also going to receive 12 monthly cash flows. At the end of the year, not a penny of tax is owed because the tax isn't owed until you sell the actual investment, right?
Oh,
and
okay.
this is the same whether or not you reinvest. It's completely agnostic of whether or not you reinvest. So if you don't sell the residential fund for a period of 5 years, as an example, you're not going to pay a penny of tax until the end of year 5.
And you're paying it just on those yearly, based on what the yearly income would have been?
Yep, that's right.
Okay, that's good.
So it has its own tax deferral mechanism built into it, which is quite similar to an RRSP.
I was going to say, it's like
actually.
an RRSP.
Yeah, very similar. And there's a second added benefit of the residential fund from a tax perspective. Even when you do sell, let's go with that example, at the end of year 5, you sell. So you're going to have to pay all of the tax that you've earned, on all the profits you've earned, rather, for this investment from years 1 through 5. Not only have you deferred tax to the end of year 5, but all of the tax owed on every piece of profit you've made is taxed as capital gains. And that includes the cash flows.
Nice.
Now, if you went out and bought yourself a duplex and rented it out, that is not considered capital gains.
Yeah,
it is fully taxable income. So even when you are paying tax, it's a very favorable tax structure.
So are you paying it on the accrue, because you're accruing more equity as you're you're reinvesting it back in? Are you paying it on? That's why I'm saying, are you paying it on that amount in the each year, or because you're making money on money now, or are you paying on the full amount?
You're paying on the full amount.
Okay.
Yeah, and there are some, we'll say, complexities with which this is calculated. Again, not suitable for a 25-minute video, but if anyone's interested in learning exactly how it works, reach out to myself or either these guys, and then we can go through it.
Sorry, I don't want to. Tell us a little bit about your backstory.
Sure.
I've heard that you also own a few properties yourself.
I do.
And
I'll give you a little bit more about how I ended up here. We'll say. I've been a real estate investor for all of my adult life. I bought my first property at 23 years old. Me and 2 buddies, so 3 of us total, all in our undergrad. We each went to our parents. We begged and borrowed for 20 G's to buy this property. We each put in 20K, 60K down payment on a house, just a hair over 400K in London, Ontario. It was a truck insurance business. It was a commercial property, downtown zoning. We converted it from a commercial property to an 11-unit lodging house. And shortly thereafter, we were contacted by a fraternity that wanted to move in. And so that house is now a fraternity house. We have 11 great tenants. We still manage the property to this day. And that was, over 12 years ago now, 13 years ago, I think.
It's funny you say that. I had a friend that says, if we'd only asked our parents at 20 years old for 20 grand, the difference it would have made.
Yeah. Well, now you
asking
can't
is
do
one
that.
thing. Is
Yeah,
getting
getting it's
another.
one. I know.
For
20
sure,
grand
for sure.
doesn't get you. It doesn't get you.
No, that's what I mean.
anyways, right?
If my son came to me today
Yeah.
and said, I need 20K, and I'd like to buy what?
Yeah.
A used Honda Civic,
Sure,
maybe.
yeah.
Maybe, right?
maybe.
But I was very lucky to have, obviously, a family that could extend to me that
Right.
temporary loan. And of course, I paid them back. I want to say that.
Right.
But that really got my taste of real estate going. I learned a ton doing that first project. I made so many mistakes. We all did. We thought we were bulletproof. You know how you are when you're 24 years old. You think you're invincible. What's the worst that can happen? It turns out a lot.
Right.
A lot can happen, right? But it really got my education process in real estate going. I ended up purchasing a duplex here in Toronto that I also run. And that's the entirety of my real estate holdings. And I still run both of those properties today. And now my investments consist both of direct real estate ownership, but also passive investments like Equitons.
Where are you buying property? Are you buying property in the States, all over, anywhere in the world that makes whatever makes sense, or where are you concentrated?
Yeah. So our two funds have different geographical mandates. The residential fund is a pure play residential real estate strategy, strictly national. So it can be Canada-wide. Coast to coast to coast. Now, even in saying that, the majority of the profits, 29 out of the 31 currently, are located all in Ontario. So for your Ontario viewers, these are going to be markets they're very, very comfortable with. Yes, in the GTA, but also the secondary markets in and around the GTA. We moved into these secondary markets largely because of the higher cap rates, right? Much better passive cash flow experiences coming in secondary markets like Guelph or Kitchener, Kingston, right? A little less so, of course, in the GTA. But we own properties throughout southwestern Ontario.
And those are typically better cash flow, not as good capital appreciation.
Exactly.
Right?
And again, the idea here is balance. We want a little bit of everything. We don't want an entire portfolio in Toronto. We don't want an entire portfolio of brand new buildings. We want some diversity across age, geography, right?
Well, the fact that you're saying Ontario already makes me feel comfortable because obviously we're very familiar with that. If 29 out of 31, it's nice to know. What about your development?
The development that we're currently offering is in the city's East End, so it's in Scarborough.
Yeah,
right. Very, very close to the water. It's a 4-minute drive from the Scarborough Bluffs. It's one of the main reasons why we chose this project over so many other potential projects. We wanted to be close to the water. And it goes perfect with our target demographic on the condo sales as well. Right?
This is why maybe working with a firm like yours makes you feel a little cozy inside, because when you're dealing with a public company, I mean, I have no idea what's going on.
We don't know. When you deal with a public company, there's zero level of access. Your comfort level in investing in a stock is in the numbers, right? You're like, oh, if there's 3 million other people buying Tesla stock, maybe I'll buy Tesla stock. They can't be wrong. Well, look at cryptocurrencies, FTX, right? Turns out they were wrong, right? These are very, very educated institutional clients that were all wrong. You have a level of insight and access to a company like Equiton that you're not going to find in a public company, which you would think is backwards. People look at us and they say, oh, you're a private company. You don't disclose anything. I don't really know what's going on there. And it couldn't be further from the truth. We're very, very transparent at Equiton. We take a lot of pride in doing so. Even with, as example, the residential fund. Every single client gets a quarterly report. In those quarterly reports, complete breakdown of every property contained in the portfolio, right down to the address of every building, the date it was acquired, the price we paid, the value as of its last appraisal date. All of this is publicly available information. And I tell clients all the time, if you're from Ontario, drive out to Kingston. Go through our buildings. Your buildings, because you own them, right? Walk through their common areas. See what you have, right?
Yeah. This is, again, this is an eye-opener for me. I'll be honest with you. Like the flexibility of being in the market without having to worry about the market.
Exactly. And you're leaving it to the professionals.
Right. And the fact that I can call you on Sunday morning.
That's right. That's right. Just after F1, please. But
oh, F1.
Right.
Not soccer.
Yeah. No. I mean, I'm Italian. I'm Italian, but F1's my sport. Yeah.
Actually, my sister got into F1 a few years ago.
See, it's after the Netflix show.
That's
it
exactly
became
what got her into
so
it.
intoxicating.
That's exactly what got her into it. Yeah.
It's like a soap opera for men. That's how I like to picture it, with a little bit of sports thrown in there.
My dad's a big
fan.
fan.
Yeah, I would highly recommend starting with the Netflix show. It's
yeah.
fantastic. Yeah.
Well, man, thanks for joining us.
Yeah, it's my
Thank
pleasure.
you so much,
Really
Lawrence.
appreciate it.
And if anyone wants to get in contact with you, you can come through us, or we'll make your contact
for sure.
info
I'll
available
say something just quickly.
Yeah,
if you want to reach out to Equiton, please visit our website, www.equiton.com. My email address we'll put in, I guess, the comment section below or something like that.
Yeah,
So if you want to talk to me directly, again, very accessible. I'm looking forward to speaking with you guys again and any viewers that are interested in learning more.
Thanks, Lawrence.
Yeah, thanks, guys.